All right, let's talk about something that sounds simple on the surface, but is actually fascinatingly complex. How much is a company's stuff, its inventory, really worth? We're going to dive into how two companies, side by side, can hold the exact same item and come up with two completely different values. It's a real head scratcher. So this is the big question for today. How in the world is it possible? You've got a widget on a shelf. How can it be worth, say, $70 to one company, but $90 to another, even though they are physically identical? Well, the answer lies in which accounting rulebook each company decides to play by. And to solve this little mystery, we have to step into two different worlds, or at least two different sets of accounting standards, IFRS and ASPE. Think of them as two different rulebooks for two very different games. They might look similar at first, but trust me, they can lead to wildly different final scores. So who uses which rulebook? Well, IFRS, that stands for International Financial Reporting Standards, is the big one. It's used by public companies, the ones traded on stock exchanges around the world. Then you've got ASPE, or Accounting Standards for Private Enterprises. This is a simpler, more streamlined setup used by private companies, specifically here in Canada. And this split, public versus private, is the key to understanding everything else we're about to cover. But before we get into all the drama and the differences, it's super important to know that both of these systems actually start from the exact same place. There's a lot they agree on. Here's the thing. No matter which rulebook you're using, when inventory first walks in the door, it gets recorded at its cost. Simple as that. And cost means everything it took to get that item ready to sell. Not just what you paid for it, but shipping, handling, assembly, the whole shebang. It's a nice, simple, universal starting point. And this common ground, it actually goes even deeper. The ways you can calculate those costs are also the same. Methods like specific identification, FIFO, first in, first out, and weighted average are all fair game under both sets of rules. And here's a big one. Neither of them allows LIFO, or last in, first out. So far, so good, right? Everyone's on the same page. But this is where the harmony ends. We've officially reached the fork in the road. This is the moment where one single event can happen that sends the value of that inventory down two totally different paths, depending on the rulebook. And the concept that causes this big split is called net realizable value, or NRV. The easiest way to think about NRV is just its real-world cash value. Basically, what could you actually sell this thing for today after you subtract any costs to finish it up and make the sale happen? Okay, so let's walk through an example to see exactly how this plays out. Let's say we have an item in our inventory. We did all the math, and its original cost on our books is a nice, clean $100. Then, the market for our item tanks. Suddenly, its net realizable value, what we can actually sell it for, drops to just $70. Now at this point, IFRS and ASPE are still holding hands. They both agree. You can't just pretend it's still worth $100. You have to recognize that loss and write the value down to $70. But wait, the market bounces back. The NRV of our item climbs back up to $90. And this, right here, is where everything changes. Under IFRS, you get to reflect that good news. You reverse the previous write-down, and now your inventory is valued at $90. But under ASPE, nope, sorry. Reversals are not allowed. That value stays locked in at $70. And just like that, you have two identical items with two very, very different values on the books.
This really gets to the heart of ASPE's personality, if you will. It's conservative by nature. The rule is absolute. Once you write something down, it stays down forever. It's a one-way street, and it's designed to be simple and to stop companies from potentially overstating how much their assets are worth.
And believe it or not, this whole reversal rule, it's the biggest difference, for sure, but it's not the only one. Let's take a quick look at how this divide gets even wider in a few other key areas. So think about borrowing costs, like the interest you pay on a loan to make your products. Under IFRS, it's not a choice. You have to add those interest costs to the value of your inventory. It's mandatory. But with ASPE, you get options. You can either do the same thing and capitalize it, or you can just expense it right away. And that choice can make a pretty big difference to your asset values and your profit for the year. This difference in thinking even applies to some pretty unique items. For things like livestock or crops, what accountants call biological assets, IFRS says you have to value them at their current fair market value. ASPE, sticking to its theme of simplicity, doesn't really have a special rule, so these things are usually just kept at their original cost. Again, one system tracks market changes, the other sticks to history. So you might be asking, why? Why all these different rules? Well, it's not random at all. It actually comes down to a really different philosophy behind each standard, who they're built for and what they're trying to achieve. And understanding this why is really the key to all of it. This table lays it all out perfectly. Look at IFRS. Its whole goal is global comparability and transparency. It's designed for public investors and analysts all over the world, so it needs strict discipline. Now look at ASPE. It's all about simplicity and relevance for private owners and their banks. The key principle here is flexibility. And of course, this way of thinking totally changes how much information a company has to share. IFRS, with its public audience, demands tons of detail in the financial statement notes. ASPE, designed for a smaller group of insiders, keeps things much more limited and to the point. All of which brings us to one last big question. When you're looking at a company, trying to figure out what it's really worth, how much does its accounting philosophy actually matter? It's a powerful reminder that the numbers on a page are never just numbers, are they? They're the end result of rules, choices, and a whole story being told.